Welcome to the final edition of Takeaways for 2025. My name is Jordan Brooks, Director of Market Analytics with ALN Apartment Data. And this month's newsletter was titled Looking Ahead to 2026. The article sort of lays out some things to watch for next year and also details how some of the developments in multifamily performance this year may or may not carry over into next year. But I wanted to touch today just briefly on one aspect that wasn't expanded on all that much in the article, which was the element of new supply pressure that is going to be coming from the backlog of units that are still leasing up. So when we talk about new supply and new supply pressure, generally we're talking about the units that we expect to come online in 2026. But we also need to keep in mind, given the new supply pipeline of the last few years, that we're also talking about in that conversation units that have been delivered in recent years that are still trying to stabilize. And both new properties and existing stabilized properties are going to be competing with those lease up properties. So I wanted to just kind of give you some highlights in terms of market level numbers here. A few areas where we're seeing a particular backlog in lease up units. For example, amongst primary markets, you're talking about Dallas, Fort Worth, New York, Austin, Phoenix, Atlanta. Those would be kind of your top five. But if you look at it on a percentage basis, so lease up units as a percent of existing stock, the markets that stand out from a primary market perspective in particular would be Charlotte, where lease up units account for about 11% of conventional stock, and Austin, where lease up units account for about 13% of existing stock. So these are areas where, regardless of what happens with deliveries next year, new supply is still going to be affecting the other metrics, whether that's occupancy or rent growth or lease concessions in those areas. In terms of non-primary markets, there are more than a dozen areas of the country where lease up units account for more than 10% of existing conventional stock. And the leaders there would be Asheville, North Carolina, Fort Myers, Naples in Florida, the state of Hawaii, Savannah, Georgia. Each of those have about 15% or more lease up units to conventional stock. So those are some areas of particular note in terms of just a backlog of units that are still trying to stabilize. And as we look ahead to 2026, there are markets where a new supply is going to be coming down. And again, the reason I'm focusing on this is because apartment demand was better than expected this year. It was very good. It was actually slightly higher than 2021, which I don't think anyone saw coming into 2025. And so we're anticipating sort of a return to earth for net absorption next year, which means that the flow of new units coming online is going to continue to have an outsized role in industry performance because, again, we're entering another year where in general average occupancy is lower than sort of the long-term average. And so the interplay between supply and absorption and its effect on occupancy is going to have a major impact on rent growth and the concession environment. Some areas where we actually expect deliveries to increase a little bit relative to 2025 next year would be Seattle, Minneapolis, St. Paul, Baltimore, Maryland, Tallahassee, Raleigh, Durham. So these areas, none of them really are we expecting a surge in deliveries. It's just that new supply is likely to outpace what those areas saw in 2025. And then where we're expecting deliveries to come down, these would be markets like Dallas, Fort Worth, Phoenix, Atlanta, New York, Denver, Nashville. So again, those markets tended to be those that were especially active in new supply in recent years. And if we go further down that list, you've got Houston, Salt Lake City, Austin, Columbus. All of these were very active markets in recent years where we see kind of the foot coming off the pedal in terms of deliveries looking ahead to next year. So to wrap up, I just want to layer on the demand trends that we've seen over the last couple of years. In general, migration continues to be to the Sun Belt regions, the Mountain West regions. We've still seen relatively healthy jobs performance in those areas, again, relative to other parts of the country. And so these areas have struggled on the rent front compared to other portions of the country, particularly the Midwest and the Great Lakes. But it's been a supply issue more than a demand issue. So when we see these areas across the Sun Belt and in the Mountain West starting to see reductions in expected deliveries, we anticipate the absorption trends remaining what they've been. That points to a solid turnaround in 2026, or at least the potential for a turnaround. So all that's positive. With that, I'll leave you with happy holidays, happy new year. I'll see you in 2026. And as always, don't forget to check our blog at alndata.com/blog for additional content, and your social media platform of choice, search ALN Apartment Data, and you'll find us there. Thanks.